Hello, this is Aaron Rosen, your local realtor in Northern California. Today, I'm just going to take you through a few selective snippets of Jerome Powell's speech where he outlines that they did not, in fact, cut the federal funds rate. I'm going to skip around a little bit. There's some technical jargon in here, and there's also some stuff that's not exactly relevant to the housing market, but there's some really interesting things in here, and I have a few points I'd like to make. So let's just dive in and listen for a minute.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Okay, there you have it. So the federal funds rate shall remain unchanged. There's just two little notes I want to talk about here. And one of them is, he says, in a timely manner, we're ready to respond. And what that means is, look, this is basically what happens. The interest rates are brought up, and then when something bad happens, they're brought down. So they had raised interest rates expecting a crash in the stock market and the economy. And you know what? It sort of happened a little bit, but not enough to justify. It's also important to remember that these are all lagging indicators. It takes a while for all of this to work its way through the economy. The main thing I want to address here is the dual mandate. So they say stable prices and maximum employment. There's a little interesting thing going on here, because one of these mandates is not affordability of housing. So this just begs a question to me. Why is it that the federal funds rate is constant across all of these different sectors of the economy? There's corporate interest, there's housing interest, but really this is a lot to do with the bond market. What they try to do is they try to have the federal funds rate be above inflation so that they can continue to rack up debt through the bond market. They will issue bonds, and if inflation is higher than the bonds, then nobody will buy them. So this is really the third unseen mandate of the Federal Reserve. And my proposal here is that actually there should be separate funds rate for separate things. Why is it that corporate America and the housing market have the same federal funds rate? I think that perhaps there should be a different funds rate for the American housing market. I can dive more into this in another video, but let's just continue for a little bit and see what he has to say.
I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year.
Here's another point. Their mandate is that it's 2% inflation. Well, guess what? Economic growth was at less than 2% inflation. So why is there a disparity between those? I'm not an economics expert, but I think that perhaps the inflation should match the economic growth. Otherwise, where's that extra money go? It's just going to distort the market.
Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending.